Good morning, everyone, and warm welcome at today's SHHA In-Depth session, Senior Living and Care, Is Germany Ready for Consolidation and International Capital? My name is Sylwia Ziemacka, and I'm a COO of the Senior Housing and Healthcare Association. Established almost 6 years ago, SHHA was created as an initiative to bring together industry leaders, investors, operators, developers, advisors to drive forward the senior housing and healthcare real estate sector. Our mission is to connect stakeholders, share insights, strategies, and best practices, boosting both confidence and engagement in this growing asset class. Today, with more than 60 members from across the globe, we are working together to make this sector more investable, more transparent, and better understood. The strong attendance today is a clear sign of the appetite to invest and be active in this market. We have a fantastic lineup of speakers who will guide us through the opportunities and challenges in Germany. This webinar also marks the kickoff of our series of events focusing on Germany. I would like to warmly invite you to join our upcoming SHA activities. First one at Expo Real on Monday, on the 6th of October, from 11 to 1 o'clock at the International Investors Lounge, run by our strategic media partner, Real Asset Media. We will host our thought leadership and networking session, so please join us if you are at Expo Real. And then also on the 13th of November in Hamburg, together with Swiss Life Asset Managers and Emotis, we will host a separate exclusive investment briefing dedicated to senior care and senior health, living in Germany. Please follow our LinkedIn and website to stay up to date with this and other initiatives of SHHA. Now, let me hand over to Richard Betts and our excellent panel of speakers to begin today's discussion. Thank you.
As Sylvia said, my name is Richard Betts. I'm co-founder and head of content at Real Asset Media, and we're very proud to be one of the founders and also a media partner for the Senior Housing and Healthcare Association. Super panel today for us, drilling down into the opportunities, challenges within the German market and how we see that developing, also as a comparison with what we're seeing in other markets across Europe. You will see on the right-hand side of your screen that you've got a comment page. So please do put questions in there if you've got those or comments, and we'll try to address those as we move through. First of all, in terms of the session this morning, we're going to have a presentation to kick everything off, looking at healthcare markets in Germany, the dynamics, opportunities, challenges, and then we'll have the panel where we'll look at some of that and also then drill down into the experiences of the expert speakers that we've got here today. But first of all, let me introduce Matti Schenk, who's Associate Director of Research at Savills Germany. And Matti is just going to give us some of the key numbers and I guess some of the market outlook for Germany. Matti, over to you.
Yeah, thanks for the introduction and a warm welcome from my side as well. Germany faces a historic demographic wave as millions of people are recently joining retirement at the same time. And for healthcare and real estate, this means both urgent challenges, but also unique opportunities. So let's have a look on them and on the dynamics of the German market. Germany, as the third largest economy, is per se a key target for international real estate capital, given its market size and its stability. And one macro trend here stands out, and that's the demographics, and especially the rise of numbers of seniors, and especially the numbers of people aged 80 and above. Their number is expected to rise by 51% by 2050 to more than 9 million people. And with more seniors, of course, comes more people in need of care and more people in need of full inpatient care. And you can see it on the right-hand side. We have different forecast scenario, but they suggest high double-digit growth rates over the next decades. So a tremendous rise in demand, not only for care homes, but also for assisted living, which need to be met by the market. But unfortunately, this stock is not growing as fast as it must be. Today, we have roughly 5.6 million people which are in need of care, and 86% are cared at home. So the place where care takes place in Germany is usually their own house, their own apartment. But here comes the point already today, 78% of those people do not live in senior-friendly housing. So Germany must not only modernize millions of apartments, but we also must build senior living at scale. However, there will be also in future people who cannot be cared at home. So we need way more care beds as well. Depending on the forecast, we need between 300,000 and 600,000 additional beds by 2040. And this only will translate into investment need of roughly 80 billion euro. And to put that number into perspective, to meet this additional demand, Germany would need to build up to 41 care homes every single month from now on until the year 2040. 41 care homes per month. And in reality, we are far away from that pace. Recently, the rate was less than 2 homes added per month. And so you can see here on this example that we have a tremendous and even widening supply-demand gap on the German market. And is that new build demand was not already enough? We also have to deal with a larger share of the existing stock. For the care home sector, for example, roughly 50% of the care homes were last modernized or built before the year 2000, meaning they need to be refreshed pretty soon. That's not driven by ESG. Mainly, it's more driven by the federal care home laws. So we roughly estimately talk about 400,000 beds we need to deal with, which would add an investment need of several dozens of billion euros on top of the investment need for the newly built stock. So to keep it short, there's a massive capital need both for new construction, but also for modernization. And it's pretty clear that the public funds will be not sufficient. Private capital will be essential to solve the problems. So there will be plenty, we believe, of value add opportunities, but also strategies for core investors. As it's pretty clear, to attract this private capital, there must be some kind of positive return or yield in the future in the sector. The good news is the healthcare real estate investment market was on the rise for a couple of years. You can see the transaction volume, and it climbed to slightly more than 4 billion euro in the end of or middle of 2021. However, with the shift in interest rates and also because of a wave of insolvency of operators, the volumes has declined notably, like in other sectors as well in the German market. And now, over the last 12 months, we saw transaction volumes of roughly 1.6 billion euros. In fact, that is a year-on-year increase, which is good news because in other sectors currently do not see increased rates or increasing volumes. But it's also clear, and you can see it here, we are still far away from volumes in the pre-crisis time. What you can also here see is that the care home sector in yellow remains the most liquid market segment, whilst on the demand side on the investment market, we see since a couple of years a clear shift or at least an expansion of the demand more towards assisted living and medical centers. Unfortunately, especially these both types of properties do not a lot of suitable supply on the market at the moment, which is limiting the investment volumes. Generally, what you can see here on the blue line is the share of foreign capital in the market. And what you can see is for several years, international capital was dominating the healthcare real estate market. So if we raise the question, is Germany ready for international capital? I would say it already had been in the past. But what you can see here is also the share is shrinking. Recently, the number is not really reflecting what's going on because there was a very large deal bought by the city of Hamburg, which puts down the share of international investors. But in fact, during this year, we saw that for many deals which took place, foreign investors were involved. Traditionally, it was specialized fund managers and REITs from Benelux, France, and the Nordics. And now, for example, we talk to new investors, for example, for Spain. And we know from our negotiations and talks that behind the capital behind completed or pending deals, for example, comes from the Asia-Pac region. So it's really kind of a global appeal going on at the moment. A lot of investors staring at the market and preparing to enter the market, attracted by the demographic story and, of course, by the market size. However, unfortunately, we must say it's not always easy to enter the German market because there are some, and I would say two major burdens. It's the fragmentation and the regulation of the market. The fragmentation is true on the operator side, but also on the ownership structure on the developer side. So as investors, you usually have to deal with a lot of small and mid-sized and partially regional players. And what you can see here is the share of private operators amongst care homes is on a long-term rise, but moved sideways recently. And I want to have a spotlight on the right-hand side. It's the market share of top 10 care home operators. And what you can see here on the numbers, in slightly more than 10 years, the share has risen. So yes, consolidation is going on, but at a rather slow pace. So which means there's plenty of room for consolidation in the market. And in fact, that is an investment strategy which we notice among several investors in building a platform, creating homogeneous product, which you then easier can sell in the end to international investors, institutional investors, for example. At the moment, the fragmentation, for example, means that if you have a larger portfolio, you typically need to deal with several operators inside them. And this makes due diligence processes, which are heavily focused on the operators and the quality and creditworthiness, rather time consuming. And in general, transactions at the moment takes a long time, also due to this aspect. Another point is the very complex regulation, which is especially true for the care home sector. Yeah, you have to deal with 16 different care home acts. Each federal state has one, and they are partially divergent rules, for example, regarding the single room quotas. And yeah, in practice, you might have the situation you have an identical building, and in one federal state, you can operate it for several years without no problem. But in another federal state, you might modernize it pretty soon because different rules in this Care Home Act. And that, of course, makes it rather complicated to understand how the market works. It takes a long time. And of course, strong local partners and advice is very essential for investors for the first time entering the market. So that's, I would say, our burdens from our daily work and investment market. However, there's unfortunately also an even larger open question is how the healthcare system will be sustainably long-term financed. We already saw and still see rather high insolvency numbers in the sector. Yeah, this is due to rising costs, staff shortages, but also due to slow negotiations with the cost bearers. Last point has now a little bit improved. The so-called investment cost rates were now sufficient in some federal states, what we hear. But unsolved is the question, how can people and the families can afford to live in a care home? Because now you already have to pay more than 3,000 euro per month out of pocket. That's a financial burden more and more families cannot afford. And that's why we see a rising share of social welfare dependence in the care homes, which is in fact an income risk for the operators in the end for the investors. So a comprehensive reform here is lacking in the care sector as well, or especially which creates uncertainty in this most liquid market type. One positive aspect I want to raise is the hospital reform, where such a reform was already announced. This will lead to the closure of roughly 20% of hospitals. That's, of course, bad news for those hospitals, but it must and will be compensated by more outpatient care. And that's why we see rising opportunities around medical centers at the moment. However, I said it earlier, currently a lot of product in the market. So what all does it mean for investors? So Germany is a heavily undersupplied and large market for healthcare real estate. It has strong growth potentials and room for consolidation, but we also need to be fair and say there are still some obstacles, especially fragmentation, complex regulation, and unsolved questions around the long-term financing. So around this landscape, investors need to navigate. However, despite these challenges, we are pretty happy to see that the investors' demand, especially from international side, is rising. Of course, we're happy to provide with services. And after all, I want to point out it's really clear that to face the challenges the sector is facing cannot be overcome without private capital, whether it's domestic or abroad. So I would say Germany need to be ready for international capital as well. But we need to make it a little bit easier for those capital to enter the market in terms of regulation. And now I'm delighted to hand over to the panel and interested to hear their views on the market. Thank you.
Great, thanks very much, Matti. Really interesting to get some of that data, I think, into the discussion. And extraordinary to think that there's got to be 41 you know, of these built every month. I mean, that's an extraordinary number until 2040. I mean, just genuinely extraordinary. Thanks very much, Matty. And I know you've got to leave us now, but let's pick up in terms of the panel. So super panel here. We've got Yeliz who's Chief Operating Officer at Cofinimo. We've got Michael, who's Managing Director of Capital Markets for Christie & Company. We've got Max, who's Associate Director for Operational Capital Markets and Healthcare at Savills, and Bertolt, who's Managing Director for Three Stones Capital. Let's just take a moment for everybody who's joining on the live stream, just to get an understanding of I guess your parts in the market and the areas that you're bringing. And Yeliz, let's start with you, just for a kind of brief introduction of Cofinimo, where you're operating, how you're operating, in what sectors, and specifically how that relates to Germany.
Yes, thank you, Richard, and hello to everyone. Cofinimo is a pan-European listed real estate investment trust. We're investing in 9 countries and primarily in the healthcare world. Germany is one of our largest markets. If we look at our healthcare portfolio, about 20% is in Germany. And in Germany, we have obviously the classical nursing homes, but also some clinics, assisted living, and other types of assets. In terms of market, I thank you, Matti, for the presentation. I think it was a very concise but very correct presentation of the German market, and I particularly like the fact that he emphasized the opportunities of the German market as well.
Great, thanks very much. Bertolt, over to you.
Thank you very much, and hello to everyone. Indeed, thank you, Matti, for this very concise presentation. I think that's a very helpful introduction and very true introduction to the German market. I'm representing as head of TSC Real Estate, representing a company which is primarily an investment and asset manager, but also an advisor. We have roughly 1.9 billion assets under management. Our sole focus is healthcare, which is the broad range of healthcare, starting from inpatient nursing care, assisted living and senior living, heading to rehab, post-acute clinics. We are pretty much emphasizing the ambulance sector of healthcare, medical supply, but also the infrastructure of medical supply and healthcare, which is life science, diagnostics, laboratories, and the likes. Our portfolio is roughly distinguished between, it's pretty much 60% of all of that is in the real estate for elderly people. As I said, we're an investment and asset manager. We have recently launched a fund with a German investor, separate account mandate, but also acting as an operating partner. We are acting as advisor, helping German, but also, and not least, international capital to enter the German market.
Super, thanks, Bertolt. Michael, over to you.
Yep, thanks, Richard. Hi, everyone. Really good to be here. And a fascinating presentation. Again, so many themes that we see in so many markets around Europe and the UK in particular, which is sort of where I'm based. So Christie & Co, we're a boutique advisory and transactional practice. We actually turned 90 as a company this year. You can tell I'm not 90, but that's another story. And we specialize solely in operational real estate. Healthcare for us is everything from children's services through to elderly care. We cover the whole market, and from sort of small operators to the largest corporates, investment funds, operators, new builds, and so forth. From a personal perspective, I got involved in the German healthcare market back in sort of 2006. I've been in healthcare now for 28 years, and that was really driven by the market getting really hot in the UK and investors looking for other markets that they could sort of move into. So we're really busy there up until sort of GFC, and it feels to some extent we're sort of back to that sort of point again, albeit the macroeconomic environment now is clearly different from where it was in those days. So excited to be part of this panel.
Interesting. Interesting that point, Michael, as well about the tipping point and where we are in the market. We'll certainly bring that up in the discussion. And last but very much not least, Max, over to you.
Thanks, Richard. Yeah, my name is Max Eiting, as a head of healthcare at Savills in Germany. I'm leading all the healthcare advisory, which means not only research with SWATI, we're doing a lot of technical due diligence, project management, and of course all the transactional work where Savills is famous for. Personally, I'm now 10 years in the healthcare business, healthcare real estate business. First did as a building engineer, a lot of technical due diligence, and now being more on the commercial side, doing transactions and operator search, which is a quite interesting part at the moment in this business.
Great, thank you. So as you can see, we've got a really super range of both, I guess, job title, opinion, but also expertise on the market. And a reminder, I can see there's already some comments and questions coming into the chat, so please do add those there, and I'll make sure that I come to those as well. Let's just start briefly, I suppose, in terms of the more general investment market outlook. And let's perhaps start with you, Yeliz, on this, if we can. I suppose, how are you seeing the macroeconomic conditions, interest rates, inflation, demographics, the shifts that we've just heard about from Matti there, shaping senior living and care in Germany? What's your sort of sense of that over the next, let's say, 2 to 3 years?
Well, thank you for that question. Well, generally, I think the market has been stable in the instability that we've known for the last 3 years, right? The geopolitics, the interest rates, and also the challenges on a national level. And with that, I mean mainly the financial challenges and the economical challenges every country had to face. Nonetheless, I think that we are at a pivotal moment. The market has a lot of demand, as explained by Matti. And usually when demand is really, really high, but the supply is low, market tends to adapt and finds ingenious ways to be able to do so. Having said that, I think it's probably a bit too simplistic to just stop there. I think that in terms of healthcare issues, governments need to take some position as well. For example, in terms of Germany, the operators had to struggle enormously with what happened over the last few years due to, for example, the fact that the governments were a bit slower to react to some of the concerns that operators had in terms of increase of costs and so on. Another thing is, Matti, I think, mentioned that the out-of-the-pocket expenses in Germany are quite high. And this is not only in Germany. I think there's a huge societal challenge in various countries in Europe, and governments, insurance companies, and so on need to work collectively to find a solution to those problems. I think it's a bit too simplistic to say, okay, the investors, American money, Asian money will come and save the day. Sure, but the basics need to be fundamentally okay and linked together in a way that the system altogether is quite stable and can be sustainable for the coming years.
Yeah, I think the opportunity part of it is very interesting, and the idea that we've now got stable instability, which I like. That's good.
I didn't know how else to put it, but
No,
I don't want to repeat what has been said for the last 3-4 years.
No.
But this is the beauty of the real estate market. It adapts, and that's why I called it like that. So it adapts, and probably we Generally, I believe that there are huge opportunities in Germany because of the fact that the operators have stabilized business plans. Occupancy rates have been increasing. The challenges with staff has been decreasing. I'm not saying that they're all done, but it's been decreasing. And this is what I mean with the beauty of the flexibility and the adaptability of the real estate sector. And thanks to the operators and the investors, I think that we are moving towards wonderful opportunities in the German market.
Okay, good. It'd be interesting to pick up anybody else's views on that overall kind of view and and I guess what Matti put out there. Bertold, let's start with you and your take on that.
Well, I think I, in principle, can only agree and add that, let's say, above the curtain, the fundamentals are strong. There's a huge demand, as it has been said. We see capital looking on German market. This is not the same as this also have been said. It's not the same money as it was previously in the German market. We see a lot of money from an interest, let's say, on the German market in the healthcare sector from Asia, from Middle East, from US. And so this is very, I think, very positive. Also, as Jelle said, the operators have stabilized since the refinancing costs have been accommodated. The authorities have been accommodated to the challenges. Also, the operators, the professional operators, have accommodated to refinancing structure. It's being done much more frequently and much more rigidly, etc. Since the capital markets, at least to a certain extent, have at least moderately sorted, meaning there is more private equity has come to the German market. That means that the operators start to expand again. They start to consolidate, to buy, which was not the case at all in 22 and also particularly in 23. We see even the regulations easing a bit. Already end of 23, there was a accommodation of the personnel requirements. We saw in 24 in Bavaria particularly easing the regulations on double and single room ratio. We see a trend in other federal states. It's not in fact already, but we see trend to ease personnel requirements, to ease double room ratios. So in principle, I would say that's positive. There are indeed huge opportunities because there is a huge demand. There were no developments almost at all over the last couple of years. This is still unfortunately not the case, and in my view, this will not change over the next 1, 2, potentially even 3 years, because the financial and capital markets broader environment is not there yet. So in principle, above the curtain, as I said, there are huge opportunities. There are a couple of challenges beneath the curtain, which is refinancing of the pension scheme or restructuring of the pension scheme, because and Matti said 3,000. The latest numbers are, as far as we have recently looked at, even higher on the private individual contribution to the care costs. That also applies to healthcare. That increases the cost of healthcare increases. On the contrary, the pension fund, the healthcare funds, they're very cash constrained, and this is a bit of a hot potato, which is hot since I don't know 20 or 30 years, and the politics is still, and that's the unfortunate thing. Even the current government is not really rigidly picking that up, and so it will be exciting. There are movements going on also in the politics, but it's unfortunately slow. I think the direction is right, and And there is movement, as I said, but it's not going the same pace, if I may say that. So the changes of regulations, the accommodation, the restructuring of the pension schemes, etc., and all of that, as the market would require it, I would say. So a bit of a balanced picture, really high demand, really strong fundamentals, huge opportunities. Which is dragging a bit is the politics and the regulation, I must say.
Okay, so those are key challenges in the market that need to be addressed, and particularly maybe for not just domestic capital, but also international capital. Michael, I was struck a little bit by what you said at the beginning there in the introduction about the similarities in terms of opportunity in some way between the German senior living and healthcare markets pre the global financial crisis and now. Maybe let's drill down into that a little bit, because I'd be interested to see your perspective of different markets and how you think international capital may well be seeing that. What are you seeing?
Well, if I go back to 2006, 2007, we were working with a number of family offices and other investors and private equity funds in the UK. The UK market was very, very hot. Demand story is very strong in the UK, very strong in Germany. There are many similarities, as there are in other European markets. But yields are compressed to a very low level over here. And actually, there was a kind of, well, where could we go where we could get better value, where the demand story is still good? There's a regulated environment. There are many sort of similarities. If you go through a checklist, you tick off UK versus Germany, and so people went to Germany. But one of the key things that was different then is the gap, I suppose, between where yields were, sort of in the UK and Germany. There was a much wider differential, but also capital was so much cheaper at those points. You look at where sort of interest rates were. Obviously, we're in a completely different world now, so the dynamic was different. But investors were looking at the need to develop new beds, the massive undersupply of development, but also the need to really modernize the real estate that was over there. Much bigger facilities in Germany compared to the UK. That still is the case. There are a huge number of facilities with twin or even triple occupancy bedrooms. And what we'd seen in the UK going back to early 2000s was the Care Standards Act, where essentially the government had tried to impose regulation on the care sector in the UK to basically remove twin occupancy rooms, single bedrooms, and improve the quality of the real estate. They very soon realized when they did that a lot of operators overnight said, right, we're selling up for redevelopment, for flats and so forth. And so essentially they scrapped that system, and you had the sort of the grandfather rights rules that are still in place to this day. We have a lot of homes in the UK that are actually older than the homes in Germany. But what we've seen as market forces is basically operators have evolved. They've had support from banks. They've improved the spec of the facilities over here. So I think if you're an investor in the UK looking to come into Germany, and there are absolutely many that are doing this. We saw obviously Civitas arrive last year. Going back when I was referring to pre-global financial crisis, we were working with HG Capital when they bought Casarea. We were involved with Carlyle when they then bought Casarea a bit further on. Star Capital bought what was the Adaheim business. So there's lots of sort of precedent of funds coming from overseas going into Germany. But we do have, I would say, sort of fragmented regulation, which for people coming in, looking at different federal states. If I compare Germany to the UK we have England, Scotland, Northern Ireland and Wales. For some investors, even that is tricky. They're going to be in one jurisdiction or the other. In Germany, you've got multiple jurisdictions with multiple different regulations. And the other thing is also transparency. So with all the investment in the UK, we had a big problem with an operator called Southern Cross around 2010, 2011, which was driven partly by investors not really having visibility of the trading performance of the care homes. So we've seen leases evolve. We've seen a lot of visibility in terms of trading performance and data, so that investors underwrite based not only on the quality of the asset, its market positioning, and covenants and so forth, but also actually the sustainability of rent and having access often to monthly information. talking to investors looking at Germany now, one of the challenges that they're seeing is actually the lack of visibility of that operation and the need ultimately to improve leases. We also have double net leases in Germany versus triple net or full repairing in the UK. So there's some things to get round, but I think improving sort of visibility of data, trading performance, a bit more visibility there, further clarity on the regulation and the grandfather rights for homes that don't necessarily meet the full requirements. Those are factors that are going to help give confidence to people coming in. The good news, though, is in the UK, in the mid-market, sort of older style homes, we have seen absolutely massive investment from particularly US REITs and other forms of capital. So capital does like older style assets. It just has to be positioned and pitched in the right way.
That's interesting. And Max, just coming to you, feel free to pick up on any of those as views as well. I mean, I've seen some comments in the chat. Thank you very much to everybody for putting those in, and we'll pick those up. About, you know, that in 2020 there was a, you know, an announcement which was to encourage international capital to come in. And then the question is what happened since then? Michael's just mentioned some of that. We've obviously got different forms of capital coming in. But what are you seeing, given the challenges and the regulations and those kinds of things? Is that acting as a barrier to more international capital, more domestic capital coming into this area? What are you seeing? And are you beginning to see a change there?
Thanks, Richard. I think, of course, the federal state regulation is one big barrier. On the other side, as Matti told us in his presentation, we have a lot of smaller operators, and it's hard for international capital to understand smaller operators. For example, I call them likely like hidden champions, smaller operators in the Black Forest owning or operating 5 or 6 homes, for example. This is not a case at the moment for international capital because it's not visible. There's no big track. Of course, they have a quite historical track in this area, but it's nothing which is really visible in the international context. For example, Bertolt, I think you know it best. Last year, the Civitas transaction with Aloheim. I think that's a good point. The operator is visible. The operator is really professional. I think that's a barrier as well to put international capital into the healthcare and care home market.
And does this mean, and I'd be interested to get everybody's or anybody's views on this, does that mean that we need to deal with that? You know, if fragmentation is an issue, do we think that ultimately there will need to be consolidation, and that would be positive both in terms of the investment market, but actually also for Germany, if you like, as a solution to this? Is consolidation a way forward?
If I may step in here, I think definitely. So Matti also said it in the beginning, we need to have private capital. We need to have private equity. There is no way just all of that being financed by the government in a broader view. So we need that. There is potential for consolidation, and but it needs to have a bit of a bridge. I mean, Max, you said it, Civitas with Hong Kong money in the background, so to speak, in the back, they not did all of that by themselves. So they had Aloheim, and Aloheim is also collecting the smaller ones. So you need to have a local partner on the operational side and also on the real estate side. It's not possible to straight away pick up all the smaller operators. And if I may add, Matti, I think presented the share of the operators representing the top 10 of the operators. I think there was roughly 15%. The interesting number on the top 100 operators is pretty 44-45%. So you see there's a huge progressive fragmentation. There are a lot of smaller operators, owner operators, schemes which actually cannot accommodate to the increasing regulations and bureaucracy in some part, apart from the operators being older, etc. And so there is room for consolidation. There is requirement even for consolidation, because care, especially care operation, is not a high margin business, as we know. It's rather dependent on scalability, on efficiency, on synergies, supply chain, all of that. So there is room for consolidation. There is requirement for consolidation. There is requirement for money, but I think that still also is required to be said. I'm always a bit of afraid to have that Southern Cross event in Germany, because we saw a lot of capital come into the German money. Money was to the German market. Money was very cheap, and that brought also private equity in the typical style of private equity, putting a lot of debt on the operator and all of that. We know all of that, and that is, I think, not always applicable to the care operation. So it needs to have a balance, the capital, in terms of return expectations and in terms of approach. It needs to be the right money for this sector in particular, and that, I think, applies not only to Germany, it applies to any other country. So again, requirement, a lot of room, a lot of potential, but it needs to be the right money, I think.
Great. Any other views welcome on that? I'm just going to pick up in the meantime as well. Oh, Yeliz, did you want to come back on that?
Just quickly, I'm not going to repeat everything that has said, and with, I agree with all of them. I would just like to add one element as well. It's the occupier, it's the resident. Having a diversified market with German money, international money, having consolidation, which almost always equals to more modern buildings, synergies, being able to cope with the change in regulation, being able to cope with technical updates of the building and so on, is ultimately also better for the resident, who will get better care, who will get better service and so on. I do agree that there are many medium-sized operators that are doing a tremendously good job, but there are also owners or operators with one, maybe two homes, with no plans to who will take over the home after they leave the business and so on. So I think generally it's better for the market, but also for the residents.
Yeah,
that's true. And if I may add that, sorry, to looking back before 23, I would say, what was the sort of nature of a good, high quality operator? Size basically mattered and was above everything, and that's not the case anymore. So we saw a lot of big operators struggling because of their size and because of not decisive approach in terms of growth, in terms of operation. So a good operator today, and that might be a bit of a guideline, needs to be locally integrated, needs to be very focused on that region. That depends on the option, probably first and foremost, to switch staff, to be efficient with staff, and to focus on the requirements of the region. That doesn't necessarily mean that size is not counting anymore, but the operator growing and acquiring smaller operators, they need to have a local approach. Maybe that's the right it's the right message. And indeed, the resident is to be focused on that. That is something which we say for a long time, and it applies to the real estate for elderly people in principle. I mean, we always talk on care. Elderly people, let's say above 65. It's not that 65 01 care, all of a sudden care. We need to perceive the elderly people as a customer with different needs, with different requirements. And that is at some point care, but and 100% care. But on the way to that, there is a lot of room for a specific and a very decisive approach.
I think just to come in, the model we were talking about there, having these regionally based operators, is exactly what we've seen in the UK. You know, we go back 10 years, people were trying, you know, the corporates were growing, companies were being sold up to the corporates, but we've been doing a lot of work over the last 5 years. Corporates have been streamlining their portfolios and assets have gone back to the regional operators who have been in the homes every day. They've put investment in. They connect with the local doctors, people. It's a much more effective model, and certainly what we're seeing in the UK with the REITs and everyone coming in, they want to partner with these really good regional operators and go with them on the growth journey and see them as a long-term partner. And I think that's potentially a model for Germany going forward. It's how you probably increase the visibility of these excellent operators to capital looking to come in, and also helping to educate capital coming in around the changes that have been made in the regulatory system. There's a lot of concern about the wage rates going up a few years ago and margins being squeezed and operator insolvencies. Some people that I talk to still have that negative thought in their mind, sort of looking in. But I think we are absolutely on the crest of a wave now. We're sort of seeing good things happening. Fundamentally, we've got a massively good demand story, as has been shown by the presentation earlier. And I think that's really the key thing. It's how you unlock it.
Yeah, I think that's interesting. I'm going to pick up just because there's sort of 13-14 minutes left, so I want to pick up on some of the comments and questions that are in the chat just briefly. So there's one which is huge opportunities in many markets, but the need is for 60 to 75. So interestingly, picking up on your point there, Bertolt, not just the oldest people. So is there really a balance in senior living markets to create the best living market there? Will operators who are facing issues with high rents be able to improve their margins to get back to sustainable rent levels without having to deal with rent adjustments? Interesting one on the implications for the E in ESG for healthcare properties. Is this a big challenge when it comes to increasing energy efficiency and decarbonisation? And more questions coming in just as we do this, actually. And picking up that point on small operators being the backbone of the industry. And a question about big operators, if they're coming from the outside, bringing their own beliefs, imposing cultures on local operators, not always working, and giving an example there of the US going into China. And is that something that, we need to be careful of in terms of the German market? And the last one here is, do we think that it would boost investment if it was possible to create a true triple net lease, not at risk of legal challenges? So quite a lot of different things in there. So feel free, anybody, to pick any of those up. And Max, I think let's start with you on any of those that you want to pick up on.
Well, maybe I go to the smaller operators again. I think Michael said it right. We need to educate international capital, to work with smaller operators, smaller family business. Sometimes it's like a clash of culture, where a smaller operator who does a great job in his region, has 4, 5, 6 care homes, and then coming to a big fund is not this professional, and we need to negotiate a lot and to educate both sides how both participants are thinking. I think that's one point. And another thing is, I think there are some good stories about being overtook by some bigger operators, but of course we have some negative examples. And I think on the investment side, it's really a good idea to write in the contracts some of reporting duties, getting all the figures every quarter, and maybe to have a big view on this property.
Could I pick up the triple net point, Richard?
Yeah, do, yeah.
On the leases, because it'll be interesting to get Liz's perspective as well as Cofinimo. Obviously, different European geographies where you're more familiar with, or you're comfortable with double net. But certainly, a lot of the funds that we work with in the UK and the US REITs, etc., coming over, they do work on the basis of a triple net type lease structure. And I think the worry for them doing double net is essentially the age of some of the buildings and the issues that may need to be addressed with sorting out twin occupancy bedrooms to singles, room sizes, and all those other points. So I think that was actually a strategy that a family office I was working with back in 2007 was looking to do, which was to put in triple net leases. But I think someone raised it in one of the questions. The legality of those agreements in Germany has always been an interesting area of debate and focus on by the lawyers. Is it actually a defendable triple net agreement, or is it a double net in effect, which causes some risk? But if I look at the likes of Amiga and World Tower, the US funds that have been coming into the UK, they've been working with operators of all sizes and scales, really partnering with the regional providers and helping them grow. But it's been on the back of triple net FRI leases. It's been on the back of good visibility of trading performance, a more sort of mature environment in terms of disclosure and visibility. And I think those are probably, if you can crack some of those, then I think there'll be that will open the doors a lot quite nicely.
Yeah, Liz, did you want to pick that up?
Yeah, absolutely. Yes. Well, generally, a triple net lease is I think, more readable for an international investor. So I completely understand that investors outside of, let me say, Europe, or even in Europe, prefer the triple net leases. It's easier. You don't have to consider upgrades, technical upgrades. You don't have to have discussions of who's responsible for replacing this or that installation. Having said that, at Cofinimo, although we prefer triple net leases, we do have local teams for example, in Germany. So we all our leases are double net in Germany. So we do have our local teams handling that as well. So we, given the fact that we have a local team, do not consider it as a problem. And then one interesting thing, Michael, you mentioned is there's double net and there's double net, right? Because you said double net and then you talked about change of regulation, who's going to be responsible for that. I think it is quite important. It is really important to understand what are the market fundamentals or market standards in a country in terms of, for example, change of legislation, which might not be in a double net lease immediately for the landlord. So there are several topics that might need to be considered. However, if you allow me, Richard, I would like to just get back on one thing. We mentioned that it's important to have a strong local operator. I agree with that, with one tiny comment. I think it's important to have operators with strong regional presences and teams. I don't think that an operator should be limited to one region specifically, provided that they have the right teams and the right people working on the grounds in those regions, in those cities, and knowing the market dynamics. And then last but not least, just a tiny comment on the size of operators. There's a huge difference between a monopoly and then the small size operator. Probably all of us have another idea of what's a small size operator or what's a medium size operator. So the problem with all these discussions is that we don't necessarily know what the clear definition is of a small operator or a medium-sized operators. Operators with 5, 6 homes generally do a very good business in Germany, given their local presence and so on. I think Max made a very interesting comment on the fact that we need to educate the international investors in being willing to collaborate with those medium-sized operators as well. But then, Max, I think the main problem is the lack of transparency of the German market in terms of operational figures, not really, also, but not only the size of the operator. So, those two elements should be tackled all together.
Totally agree, Yeliz.
Okay, good. Some interesting points there. There's around 4 or 5 minutes left, so I wanted to pick up a little bit on particularly future strategies, future opportunities. There's obviously the traditional care homes, and they may be a big opportunity, but how do we see new asset classes, operational models, assisted living, integrated senior communities, healthcare hubs? You mentioned a number of those different areas that you were working in particularly as well, Bertolt. So do you think these will help define the next kind of phase of growth, the next opportunity? So I suppose that in a big bucket, that is, where do we see the future opportunities here? Who wants to pick that up?
Shall I go? I think it's a combination of everything, essentially, and that's what we're seeing. It's that sort of care pathway, or that as someone gets older, in the UK, we have situations of people still living in massive houses, one person in a massive house when they're sort of 80 years of age, fall down the stairs, hurt themselves. It sort of blocks that house going into the family household market. So this sort of downsize point is really big for us in the UK. We're seeing massive challenges in actually getting assisted living schemes built because of planning and regulation. It just takes forever to get planning consents. But I'll give you a very personal example. My mum's 91, and she lives in a retirement village, and she's had some health issues, but she's on a new lease of life and having a fantastic time because of the mental stimulation that she gets there. But it's actually developed by a care home operator who prior to being a care home operator was actually a pharmacist. So he's gone from being a pharmacist to a care home operator, and now bridging that gap between care home and assisted living. And we're starting to see that a bit more in the UK. And I know that's been a model that's been quite prevalent in Germany, with operators doing both. You see that with all the big corporates, but it's a combination of everything. If I talk to our team in Germany, they're quite busy with assisted living, service-orientated housing. Developers find it more attractive. There's less risk. It works in different ways, but you do need a combination of everything. People are living longer with more acute health conditions, and they require appropriate care. So it's having that wide model, I would say.
If I can add to that, I mean, indeed, it's a combination of everything. I think to be a bit more specific, capital very much likes the stability, yield, and cash oriented, which is primarily because it's governmental backed, at least in part. The care, the inpatient care. There's a huge demand on the outpatient care as well, as we know, assisted living, and not least on the service living, senior service living. And there's a huge demand also in medical supply, particularly ambulant medical supply. There's a huge transformation going on from the inpatient hospital to ambulant outpatient medical supply. The issue with all of that is that there is no development going on. Mm-hmm. And that is there primarily 2 reasons for that. First, the majority of the investors come into Germany. That counts not only for the foreign, but also for majority of the domestic, is looking either for cash, for yield, or for roughly more IRR oriented. But these type of investors, the majority of them, they don't like risk, still don't like risk, so they don't want to develop. They would like to add value from existing assets, which is very difficult in the healthcare sector. and difficult also from a volume perspective. You find opportunities here and there, but it's not applicable to the strategy. So that's one. And the second is, of course, the capital markets, because construction costs are still where they are. They will not be reduced. Whilst a couple of years we had prime yields of three in assist, depending from senior living to inpatient, from 3.8% to 4.3%, I would say 4.5%. Today, you cannot almost not justify 5.25 per 3.3%. There are prime yields populated, but there is no market. There are actually no prime yields. So let's say the average yield is probably around six a quarter yield. And so constructing and having room for margin, because you cannot let's say construct and develop much lower than 5%, maybe slightly lower, and there is no room for the margin. So there is no development going on, and there is no will and for taking risk. I think so. At least the first part, I would like to convince people to look into details, to look into taking risk, at least construction risk. That would foster the inpatient care, but also the senior living, the assisted living part, and also the other sectors, which is really required. So we need the capital, being willing to take at least slight risk, a bit of a risk, and also, of course, we need to have the markets being accommodated to that.
Great. We're almost out of time. Well, we are in fact out of time. But I'm just going to steal 15 seconds, just because I'd like to get your view, Yeliz, and your brief view as well, Max, just in terms of the future opportunities when we're looking here. So a brief view on those would be great.
I do agree with Bertolt that the construction prices are still high. I would, however, remain a bit more optimistic. I do hear and see signs of also recovery from the developer side. Development now is on a very low level, but I believe that things will probably be a bit more different within 12 months. Overall, I think we all agree of the tremendous opportunities, challenges, yes, but opportunities as well of the German market. And then I hear lots of interest into understanding better the regulation. Nobody challenged the figures. Nobody challenged the demographic figures that Matti showed. We talked about regulation. We talked about fragmentation. We talked about economic pressure on the residents because of the increasing out-of-pocket expenses. I truly hope that not only the private market, but also the authorities and the governments work together and collaborate into finding ways to improve the system for the resident to begin with, and also to attract investors to the German market, because that will create huge opportunities for the German government overall as well.
Great, thanks. And finally, just quickly from you, Max, what opportunities? Well, you're on mute, Max, actually.
Sorry,
We want to hear those opportunities.
I agree with Michael, Yeliz, and Bertolt. I think first of all, it will be a mix of outpatient, inpatient care, as well as all the hospital reform, which could be a huge opportunity as well, with all the medical centers. And of course, there will be always nursing homes, but we need to think about some other types of care work in assisted livings, and maybe some in Germany called Pflege-WGs, for example. So yeah, there will be always a mixture.
Great, thanks very much. Thanks very much, Matti, for the excellent presentation at the beginning, and thank you for hosting this, Sylvia, as well, from the SHHA perspective and the team there. Really interesting panel discussion. Thank you also to everybody for your questions. I hope you found that valuable. And if you've been watching this live, thanks very much for joining. And if you're watching it on demand, thanks very much for joining us. Thanks very much, everybody.